Hi, this is Grant of Fortuity Risk Analytics. So there's been a lot of chatter about what's really driving commodity prices. There's the argument about technicals versus fundamentals, which one's better. And what a lot of people forget about is actually the US dollar, because commodities are priced in US dollar. So here we have a chart, the blue line is the DXY, or the US dollar index, and that comprised of 57% euro, 13% British pound, 12% Canadian dollar, and then there's 9% that makes up various other currencies. So what we can see here, the blue line being the US dollar, from about 95 until 2001, we had a substantial run up in the Dixie, and commodities underperformed during that time period. And the same thing over the last few years. As commodities have sold off, the US dollar's pushed substantially higher. So from about mid-2014, as the dollar pushed about 20% higher, oil was actually off roughly 46%. And what we can see here in 2016, the US dollar is down and commodities, the CRB index, has moved substantially higher. So we have to look at the relationships. It's an inverse relationship for commodities versus the dollar, and that's really the leading or driving force behind where any of these commodity prices move. So if we take oil as an example, there's a lot of daily or intraday movement based on inventory draws or builds. But really over the long term, if the US dollar pushes higher, usually oil will move lower, and that's what we've seen over the last couple of years. And what we expect to happen in the near term future is if the US dollar moves a little bit higher, oil will continue to sell off. So it's really important for investors to track the relationship between the dollar and the commodities index. That's really the driving force behind any of the long-term substantial price moves. This has been Grant of Fortuity Risk Analytics.